Hello and welcome to the Trading with Ashley show. I hope your trading went well today. I'm really excited to bring you this particular episode. So, as any good teacher would do, sometimes I like to review my students' trades and give them grades on how they did. It's important when you're teaching that you reinforce the concepts and that you look and inspect what you expect when people are trying to follow your lead on keeping trades safe and making good decisions. So in my Discord, I have a whole section where I let members put their particular trades, and it's really helpful. A lot of times I will see some of their trades and like the trade, and I'll go and make it myself and then alert all of my members that I too made the trade based on one of my students' recommendations. And so if you want to see all of our trades and take a look at what we're doing, feel free to click the link below and look into joining our Discord. For those new traders that don't have large accounts right now and you just want to kind of learn the different X's and O's of trading, I have opened up something called the New Trader Network, and that may be just right for you to consider. I've got that link below as well. Now, if you are ready to do this more full time and you really want the commitment, I do have a few spots left open in my boot camp coming up next January. But with that being said, let's go take a look at some of my students' trades and see how well they did in the last couple of weeks trading. The first trade we're going to look at comes from Market Maverick. This trade was done on 11/24, and he sold a Google put expiring on 12/20. His strike was 155. Now let's go evaluate that trade on the day that he made it. So Google was definitely trading down this day. And if you look here, it was right here at the bottom of the Bollinger Band. The bottom of the Bollinger Band on the 1-month chart is about 164. So our trader did a very good job because he went below this band. This band offers some protection against a stock falling too much because it likes to stay within its bands. As you can see, looking on the history of this stock, it does respect its bands and it'll bounce off of it and come back up. If it goes above it, it'll retreat back under it. But Google did have a sell-off with the potential news of the breakup of the different divisions of their company. And so he struck when this happened and he made what I would consider a very good trade. Let's see, he chose a strike right down here about 155 and he made it expire on 12/20. So let's go see what he may have received in premium for that trade. If you go and look at this trade right now, the 155 strike for 12/20, it's actually about $15 away from where we were when he sold this. It's 49 cents now, so it's whittled down. But if you look at the delta 0.15, obviously it was different at the time. But I imagine our trader probably got between $400 and $500 for this trade because when a stock drops really fast, traders are nervous and they want to go buy insurance. They want to go buy a put so that they don't lose too much money if their stock starts tanking. Well, if you're an option seller, then you jump in to sell the put. And he made a very good decision because this trade still has several weeks left in it and it's only 49 cents now. So he could buy it back probably anywhere between 80 and 90% profit and enjoy an extra $500 in his account. Now he only had to put up for this trade $15,500 to receive a significant return. So that's the moral of the story here. If you've got a quality company like Google that has a drop and it drops fast on any particular day, be ready to strike at a level of support for the stock so that you too can enjoy some extra premium like this that he received on that particular day. Next, I want to go take a look at our trader Eric. He actually had some Dell shares and he had sold covered calls on them, but he saw that it was going a little bit higher. So he actually did some great trade maintenance right here. He rolled for a credit. He received a little bit over $500 to make this change. Initially, he had sold the 143 covered call. He wanted to enjoy Dell going a little bit higher, so he went ahead and went with the 146 strike price. He rolled it out 1 week, and he made it expire on the 29th, and for that, he received this credit. The beauty of this trade is he not only got this credit of $5.12 per share, but he also is now getting to enjoy an extra $3 in price appreciation from 143 to 146. let's go take a look at Dell and see if our trader will be able to keep 100% of his shares and enjoy keeping also 100% of this premium. Now, this was a trade done over earnings, and so it's risky in the sense that if Dell would have surged ahead over earnings, his strike price would have been breached. But as long as he is selling a covered call above the price he got the shares at, he really can't lose. He can just miss out on opportunity. So looking at this, he made a very good decision. He sold a strike price right above, right here, about 146, and he received a credit for that. And now that Dell has had their earnings after hours, it's retreated to 133. So he gets to hold on to all of his shares, but because this is pulling back, he now gets to keep 100% of the $500, $512 that he received. Now he can wait until Dell surges ahead again and sell another covered call. So this was a really good trade, and it's a way to hedge your position with an event like earnings if you want to take advantage of getting some credit in advance of the trade. Now, keep in mind, if Dell had surged ahead, let's say to 155, he would be leaving money on the table because he had went ahead and capped himself at 146. Although he could roll the trade again and enjoy more stock appreciation just like he did the original trade. So that's what I love so much about options, especially if you are selling covered calls on your trade, because you really can't lose. You can just, in that situation, if your shares are called away, you can cap your upside, but you cannot lose the trade if you bought low and you sell a call that is above your strike price and they're called away, because then you get all the cash from this trade being called away, and then you can go and start selling puts. Next, we're going to take a look at what our trader Steve did. He actually sold this particular put on November the 20th. It was for Qualcomm. He sold the 1220 put, 150 strike, and he received a nice credit for that, but that was 461. So let's go evaluate his trade. So on the day that our trader made this decision, it was 11:20, and you can see this huge red candle. So he has a lot of confidence in this stock to sell a put on a day that's so red. But when you look at it, he did go below the action. He sold the 150 put, and actually that is a level of support. If you can see right down here, it touched it at 151, and then if you go out even further, you can get a better look at it, and it does look like there is a level of support right here at that 150 level, just based on how your candles look. And then we were definitely in an oversold situation because this is 41 right now, but on that particular day, it would have been lower. It would have been closer to 30 with that sudden drop. So he chose a decent strike price. The only thing that provides some caution to me for this trade is I want you to notice that it is trading under all of its moving averages. And so this would have given me a little bit more caution. Typically, you like to see the moving averages with the lowest amount on top. So this being the 20-day, if a stock is super healthy, you want to see the 50-day underneath it and then the 200-day underneath that. So right now, this trade is working out okay for our trader because he chose 150 strike, and it has definitely come up since then, and he might be out of harm's way. We'll just have to wait and see how this trades. But at this point, it looks to be okay. The reason he received so much in premium when he made the trade is because he was taking a bigger risk with a stock that's dropped that fast and the fact that it is trading under these averages. So that's something that's really important to keep in mind. There is no free lunch. If you are going to receive strong premium, it's because it's a riskier play. All right, our next trader, Nightstorm, he did a sell to open put on Palantir. He made this trade on November the 20th. And he selected the 11/22 expiration date and a 59 strike. For that, he received 82 cents a share, so $82 for the trade, and he would have had to put up $5,900 for the trade. So let's go look to see what the price action was that day, and obviously that day has come to pass, so we know he's good with the trade. But let's go take a look at when he made the decision and grade how he did making the decision that day. Okay, 11:20, it looks like we were trading right here around that $63 mark. So when he selected his strike price, looking at so when he selected the $59 strike price, that was right about down here. Now, he probably saw this level of support with the candles prior, and that's what gave him some confidence. He was probably looking at the delta as well. One thing that does provide some support for this stock would be this middle line right here. It's the 20-day moving average on the 1-month chart. It's the middle of the Bollinger Band. And so had he been put the shares, he could potentially have seen this drop a little bit further down to this $56 level. So the idea entry on this stock would have been waiting until it actually was closer to the 20-day moving average, because it is above 50 on the RSI. So when it is above 50 on the RSI, we do typically deal with support levels in the top half of this band. And so it ended up being a trade that was profitable for him. So he got to keep all that premium. He did take a little bit of a risk, though, by not waiting until it had come down closer. But you can see in this scenario, had he had waited, I don't think he would have got the chance to actually make the trade. So for that, I will go ahead and give him an A minus. The only reason it's not an A plus is because he didn't wait, but he ended up making the right decision. In hindsight's 2020. So very proud of our trader here that he was able to keep that. Now, also, he may have been in a situation where he was super happy to hold on to Palantir. Maybe he had not received enough Palantir through his other efforts. So he wanted to do a more aggressive strike, allowing a better chance that he would be put the shares, because he plans to hold on to them for the longer term. And Palantir has recently received a $75 strike price from analysts, and so that would give somebody confidence to take ownership of those shares at that $59 price. And finally, let's go take a look at what our trader, Dangerous, that's such a fun name, right? So let's go see how Dangerous was when he made this particular trade. This one was done on 11/20, and he sold a put on Coinbase. It was the 267.50 strike, and it was expiring 11/29, so that's upcoming. Now, I like that he puts a little bit more information here to help. Obviously, he received 460 for the trade, and the delta was 0.17. So I'm already impressed because he went below the 0.2 delta. And the 0.2 delta is what we typically look at. That usually gives us about a 20% chance that it's going to hit our strike. So he went even lower than that, and he did receive some great premium. So let's go take a look at what he was seeing when he made this decision on November the 20th. He chose the strike price of 267.50. So look, that's way down here. This is underneath the 20-day moving average, and we use that as a level of support because we are 57 on the RSI. Anything above 50, it's fine to use this as a level of support. So he did really good because he went under 270, and that provided a measure of support. And look what happened. It was coming down and getting a little bit closer. It already has rebounded, and now we're looking at 293. So he should be in a really good spot for our expiration date in a few days, and he should be able to keep 100% of the $460 that he received. And for this trade, he would have put up about $26,750. So in conclusion, with this particular trade, I would give him an A. So actually, even though his name is Dangerous, he was not very dangerous because he did use levels of support. He used the fact that we're still in a bullish mode, and he struck on a day that the stock had dropped. And he is still trading well above our moving averages right here, especially the 200-day moving average. Our stock is above that. So he did very well. So Dangerous, even though your name is Dangerous, I think you were very safe on this particular trade, and I'm proud of you. And as any good teacher would, I have to give a special shout out to our very own coach, Tim. Tim started off as one of my students, but he's so skilled at trading that we are celebrating him because he just hit a personal goal of over 200,000 milestone in premium alone with selling options. So we're very proud of him. And if you get a chance to ever join us in Discord, you will get to see all of his trades as well. I hope you enjoyed this segment. It was a little different. If you like seeing things like this, where actually I show you different trade setups, maybe either from me or some of my students, or you just like to see a variety like that, make sure you mention that in the comments below, and I will work in some future videos to keep offering you some different opportunities like this so that you can learn alongside us. Remember, if you are with Trading with Ashley, there is no trader left behind. Now, if you want to watch me teaching my daughter how to trade, you can watch that video right here.